Today, household finances and the future of interest rates. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news. Today, I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
Great to have you back on. And I think we chatted last time in November when the RBA lifted rates. And then, of course, rates have gone sideways officially over that time. But I thought it was time for us to get back together again. I'm getting a lot of questions from people now about the trajectory of rates, the expectations maybe that rates will be higher for longer and maybe even having to go up. So I wanted to really get a sense from you as to what's been going on and what are the main trends with regard to mortgages and deposit rates and credit cards.
Great.
Let's start with mortgages because, of course, that's where a lot of people are in hock at the moment.
Yeah, look, people are doing it pretty tough. It's, there have been 4.25% worth of increases since May 22, and that's enough to add sort of $1,500 to your average looking mortgage. So people are doing it really tough. Now, it's uneven, of course, and not everyone's suffering this because 2/3 of mortgage owners are doing it pretty comfortably. They're ahead already and they had small mortgages. More recent ones, though, and around a third of people are saying, look, we really need some government help to meet our repayments. Now, I don't think that's going to be coming. So they're doing it pretty tough, the people who bought more recently big mortgages and really stretched to get into the market when housing prices were sky high. They're sky high again now, of course. So where are they going to go, I guess, is what we're really interested in. And gee, inflation's not coming down. And it came down very, very quickly to begin with. But that was just really the supply side influences working their way out of the economy. And once that sort of free kick disappeared, now the Reserve Bank is at the hard end where they've really got to get demand under control. And they thought they were under control, but gee, it's now back to looking at 4% per annum inflation. And if we get another quarterly figure around 4%, I think they'll be very, very tempted. It'll be hard for them not to actually increase rates again.
Yes, and of course there's a political pressure coming from Treasury and Jim Chalmers saying, oh, we've done things to try and help the cost of living, et cetera, et cetera. But the Reserve Bank said they're going to look through some of those temporary support measures. The fundamentals are definitely different from what people were expecting, and there could well be higher rates ahead. But with regard to mortgage rates, of course, there were some fixed rates that were quite low that people have been rolling off, the so-called mortgage cliff. But what are the typical mortgage rates that people can get now?
The average rate that people are paying for their mortgage is 6.4%. Now, that's the Reserve Bank number, and I believe that one, they get that straight from the banks. But the average mortgage is about 6.8%, so higher than that. So if you're in an old mortgage and haven't renegotiated, you're probably worse off than the average. You still, though, can get rates below 5.75%. All of them are fixed rates. The lowest variable rate that Canstar lists is 5.8%. So, that's still a 6.6% differential that the average borrower can get by refinancing into the lowest rate. Look, there's a big saving, and 0.6% saving on the interest rate equates to $241 a month on a $600,000 loan over 30 years. So there are big savings to be had. And why would you wait for the Reserve Bank? It's looking like it's going to be further away now. Why would you wait for them to make a move? Do something about it now. And when they eventually do make a move, you can double dip anyway.
Yeah, Steve, I am really surprised. I've had continued one-to-one conversations with people over the last 2 or 3 years. More recently, people are still not on the best rates. And it's almost as if people don't want to go and look. They don't want to spend the time trying to work out what to do. It's not that hard. And as you say, you can make a significant saving relative to the rate you could well be on. So it's worth checking that. But the other realization is that where they were and where they are now, particularly the variable rate, they're paying a lot more. And of course, that has put huge pressure on many people. And in some cases, the typical repayment has almost doubled.
Yeah, it has. It's up 60% or something in a lot of cases. So So yeah, it's really tough. The interesting thing about it too is that, look, we always say refinance, but there is a group out there that actually can't refinance. They're at the point where any lender would look at their situation now and add the extra 3% buffer that the lender has to put on, and there's no way they can afford the repayment. So the lender is obliged not to lend them the money. So there's a big group that are locked out. But for those that aren't locked out, they should be back in the market, and even if they've renegotiated once, have another go, double dip on it. And yet the refinance, and the amount of refinance is down by about 20% on a year ago. Now, that's ridiculous in this sort of environment. It just doesn't make any sense. People just have to do it. Save yourself $241. You won't get that sort of saving anywhere else.
Absolutely, and of course that's a real saving. That's, irrespective of tax and everything else. Yeah. Now, just talking of lending, the latest lending statistics came out the other day for new lending, and there were some quite disturbing trends there. The overall lending is higher, but the mix of lending on a percentage basis showed that the investors were actually piling back in, and they were squeezing out first-time buyers and in fact owner-occupiers as well. So we've got a really hot property market now. Prices are rising. We've got investors piling in. And interestingly, in my research, a lot of those investors are now buying the same sorts of property that prospective first-time buyers could be and should be perhaps getting into the market with. So this is not another good sign for rate cuts, is it?
No, it's not. We just on your last point first, the investors and the first-home buyers are very much in the same market. You look at the average loan size for both, and they're almost identical. Now, what it is, how you make sense of that is you say, well, who are investors renting to? And a lot of those people are people who want to be first-home buyers but haven't been able to get into the market. The stats are showing just startling growth in investment lending. Extraordinary growth, 26% or something up on a year ago. Owner-occupiers, excluding first-home buyers, are up about 13%, but first-home buyers are down to 10%. Now, when you look at the price increase over the last year in property, it's gone up by about 10%. So there's really been almost no real growth in first-home buyers at all. And property prices now are back up to their all-time highs, and Brisbane's just overtaken Melbourne. So property prices are high. Investors are in there scrambling to get into the market because they believe prices are going to go up further. And first-home buyers are once again being squeezed out. Now, I've only got to cast your mind back to pre-COVID days, and they were being absolutely smashed in the market, and it was investors then too. So, it's getting harder for first-home buyers to actually get into the market, and it's a bit disturbing. It's a more than a bit disturbing. It's one of those social issues that we have to think hard about.
Well, of course, we see pictures of tent cities and horrible things like that, and we know that people in the rental sector are getting squeezed dramatically. But one interesting observation about this investment story is it's a two-way street. I'm also seeing other investors who are actually now finding that their cash flows don't work anymore for the investment property, and so they're actually listing investment properties for sale, particularly in Melbourne, actually, at the moment. So it's not a universal story of success for the investor market either. And I think that's quite an interesting observation. You need to be careful if you're an investor. But the bigger social question about how you get first-time buyers into the market. The age of the first-time buyer is now late 30s rather than late 20s, which it was 20-odd years ago. And this is a really, really big and frankly, a social question. I don't think the current political responses necessarily are taking us in the right direction. We know that all the grants and other financial assistance just lift prices even further, so it doesn't necessarily help.
Yeah, look, it's pretty obvious to me that it's a supply side issue. We have got people living in tents now. You see more people around the streets in the train stations sleeping rough, and there's clearly a shortage of housing, and the market will just changes to benefits for buyers will just go into higher prices if you don't expand supply. There's no question of it. The issue too with this later into the market, I mean, European culture has long been, in a lot of parts of Europe, you buy your house when you actually inherit from your parents. Now, it's starting to look almost like that at the moment in cities like Sydney, where it has actually been just a dramatic increase in prices over the last several years. And it's starting to look like that at the moment for Sydney in Australia. So, I guess it requires a lot of thinking about what we look like as a community in the future.
Yeah, in fact, there are some articles suggesting that people are moving out of the major cities, particularly Sydney, because it's too expensive. And that, of course, then changes the social mix and all sorts of consequences in terms of not having critical workers and all those sorts of things. But there's another interesting question we should explore briefly. ASIC published a report relatively recently talking about those households that went into the bank's hardship schemes, which are typically for 12 months. And one of their observations was that at the end of the hardship scheme, because rates are still high, many households were actually in a worse position than they were when they went into the hardship scheme. So once again, I'm not sure that the hardship schemes that we have at the moment are actually necessarily tackling the critical issue either.
Yeah, what people forget about the hardship schemes is that the bank continues to charge interest to the loan, and you just don't pay that interest back. That's how they all work. You're paying a lesser repayment. You might go on to interest only, but irrespective, both of those outcomes mean at the end of the hardship period, you still owe just as much, plus the interest that you haven't repaid. So you owe more. That means your repayment's going to be higher over the remaining term, which is now a shorter term as well, which just aggravates the problem. Hardship schemes work if you're in a short-term crisis. But if you come out of, I can't afford my repayments today, and you come back into the market 12 months later, and the interest rate hasn't fallen, the repayment hasn't fallen, it's actually gone up a bit, and your income hasn't gone up, well, you're under more hardship. So they are very much designed for the short term. If you can't solve the problem in that period, then you're going to be worse off.
And that's why we're seeing some now forced sales coming through. Not forced sales in terms of foreclosures from the bank, but essentially people who realise that they just cannot keep the property that they wanted to keep. And, they struggled for a long time to try and do it. I think we're going to probably see a little more of that because of this higher interest rate for longer. But it is worth just reflecting on this horrible thought that the rates we're seeing at the moment are not atypical if you look over a longer period, right? We had a very, very low rate period, but that was artificially low. We're actually back to a more normal rate now.
Yeah. Look, I looked at this about a year ago because I was curious, and I thought, well, do the stats actually confirm my thinking about this? And we've had the cash rate concept for, I don't know, Martin, you correct me if I'm wrong, but somewhere around 30 years, could even be a little bit longer. And in that period of time, basically, we are now at the average. So the average is around this 4.25% over that 30-year period. So these are just average rates. Yep. Now, I then sort of thought I'd stress test this a little bit, and I cut out the very high rates of the Keating era, those couple of years where we were up over 18, 20%. And I also cut out the couple of years of the COVID era where we were down to sort of 2%. And thought, well, this stress tested a bit, but it didn't stress test it much at all, still about the same. So we're at basically the average long-term cash rate. And that means we're near enough the average home loan interest rate. We're probably a bit below because the banks were getting better margins for most of that time.
Yeah, and that means, of course, that the borrowing power of people have been reduced significantly because of this 3% plus the current rate, which current rate's higher, the 3% buffer is there. And so a lot of people are finding it harder to get into the market because they're chasing prices that are still running really high. And that's why the supply side discussion about, well, we don't have enough property in the right places for the right types of people at the right types of price is part of the story. But I am concerned about people still leveraging up to the max and trying desperately to get into the market, especially people who were in the rental sector and then saw their rents rise and then jumped into the purchase sector and then discovered that actually it's not any more comfortable on that side of the fence.
It's worse.
Yeah, well, it is, and this really highlights, I think, the structural issues that we've faced. And by the way, it's not just in Australia; we've got similar issues in the UK and in New Zealand as well. Although in New Zealand, prices are now beginning to fall. Let me move the conversation on, though, Steve, to talk about deposit rates, because one of the interesting reactions that we saw as interest rates started to rise, deposit rates were sort of ratcheting up, but quite slowly. And as we discussed in previous shows, not all rates moved in the same direction at the same time. And it was quite confusing. Has the landscape changed, or is it still pretty much the same?
No, it has changed, actually. Over more recent times, they've started to go up again. Now, this is another bit of research that I did a little while ago. People must wonder, how come this guy has so much time to do this stuff? But I'm fascinated by it. Interest rates for deposits tend to go up later in the interest rate cycle. And it's quite typical that banks have raised deposits. They've got plenty of retail deposits, as in household savings. And it takes a while before they come under stress on those. And it takes a while for the wholesale lending market. So that's the big end of town lending billions of dollars or half $500 million to the banks to lend out to homeowners. It takes a while for that to start drying up and for the interest rates there to go up. And at that point, it's only when those rates start getting higher, those wholesale rates, that the banks say, well, we need to pile in and get more retail deposits, more household savings. So they tend to go up later. And that is what we've seen. We've seen them going up, but later. Now, there are different paces of this movement, though. If you're looking at a 12-month term deposit, it's kept pace pretty well over the last year or something, with increases in the cash rate by the Reserve Bank. And if you look at bonus savings rates, they've gone up too. But if you've got lazy money sitting in an account that maybe you took out when you got a 3-month promotional rate that was pretty flash, but you left your money in there, you're earning a very low rate. You're earning around 2%, 2.6% on average. And yet the best rates in accounts that look like that are double. They're 5.2%. So it's really a case of, look, if you haven't moved with the time, if you haven't looked at your savings in quite a long time, chances are you're getting closer to that 2.6% than you are getting to the 5.2, 5.4% that is available in the marketplace. So it's like everything else. It's caveat emptor, take care of your own situation and keep aware of what's going on. Because if you're in the wrong savings vehicle, you will be getting a rubbish rate.
Yeah, the banks don't tap you on the shoulder and say, "Excuse me, I can offer you a better rate." Right? It never happens. So you have to do the work, unfortunately. And once again, in my one-to-one conversations and my surveys, I do see households with significant balances sitting on accounts with almost no interest rates, or basically just a cash account, or very, very low rates. And again, it's a matter of taking the initiative and seeking out the best rates and checking that what you've still got makes sense. Now, obviously, if it's a fixed rate and it's locked in for a certain period, there's a penalty potentially if you switch. But, it's worth just taking a little bit of time to understand the dynamics. Rates probably will continue in this sort of vein for some time, because we know that the cash rate is not likely to come down very quickly. Although it is true, I think, that the bank margins are being compressed. So one of my observations is that in some cases, some banks are getting a little bit coy in terms of offering the better rates on deposits, because they can squeeze the deposits a little bit and protect their margins.
Yeah, and right now it's if you cast your mind back to when the Reserve Bank cash rate was 10%, 0.10%, you sort of looked at the savings rates back then. You thought, well, geez, it's worth getting out of bed in the morning to get that extra 0.5% to get a good rate, and maybe it wasn't, but it sure is now, because it's now this 5.2, 5.4% compared to this 2.6%. So it's certainly worth it now. Now, banks do look at their deposit rates and say this is stickier than people in the home loan market. Now, the reason for it is that people's home loans are $500,000 more, and saving that 0.6% to get from average to the best rate is on a huge number. So that's a huge amount of money. When you look at a savings account, well, the average savings balance is, I don't know, $20,000 or $30,000, and it doesn't make as big a difference. So people don't get as motivated. So I understand why not, but you as a saver have done very badly over the last decade. You've been getting lousy returns. Finally, returns are getting to a more sensible level, so make sure you're getting your share of it.
Absolutely. Don't give the profit back to the bank. Retain it for your own use. I mean, it's so much easier to generate a little bit more income from deposits rather than trying to save something by spending less or prioritizing spending, which of course a lot of people are having to do at the moment. Now, one of the other traps, of course, when people get into pressure, is that they then reach for other loans, whether it's pay buy now, pay later loans, or personal loans, or indeed credit cards. And it is worth just talking briefly about credit card interest rates because, well, they're still pretty shameful, aren't they?
Yeah, they've started edging up. They took a long time to react to the increases in interest rates. Now, why did they take a long time? Well, it's because they didn't go down at all when rates were going down. And they've started now, though. I looked at a couple just the other day, just today, actually, and one of them's gone up by 1.5% or something. So they've finally started to move up a bit. Now, it's an interesting business that they're in because the write-offs are high when times get tough, and the other thing is that they've been squeezed on their interchange fees. And I won't go into the depth there, but it just means they earn less money on the transaction side and have to really make up for it with either lesser benefits on rewards or higher interest rates. And they're finally bumping interest rates up, and it's patchy. It's not across the board. And of course, if you're in a rewards account and you have debt on there that you're not repaying, then chances are you're paying 21, 22% for those frequent flyer rewards credit cards. And if you are carrying debt on them, that is just ridiculous and hurts your situation. At least get into a low rate card. Now, a low rate card is 14%. That's kind of about as good as you get, and that's not low rate. Inflation's running at now around 4%, so that's a 10% real interest rate. So it's not low, but people at least in aggregate haven't been increasing their debt, and I thought by now we'd have seen a fair bit of that. But I track this number every month, and I say to the people, let's get excited about it if it goes up, but it just hasn't gone up. It's been pretty stagnant. So it's fallen from around $30 billion odd to around 18 billion. It's even more, 36 billion or something 10 years ago to around 18 or 17 now. And so Australians have done a pretty good job in aggregate. But I think the real issue or the problem with this is that aggregate is a mix of people who are doing really well and maybe getting a higher interest rate on savings and are paying down their credit cards, and people who are doing it really tough and are drawing on their credit cards just to live. And so I think it's disguising the fact that there is a blowout in credit cards with some people. And if you're blowing out your credit card and you've got a home loan interest rate and repayment that you're struggling to repay, then the credit card is really going to hurt. That form of credit is meant for a few months to pay something off or to get you over a short-term thing, but it's not designed for long-term credit. And if you're paying 14%, let alone 21%, then it's really going to start hurting you, because you'll hit a point where sooner or later you'll be able to afford the interest but not to actually repay the debt. So do whatever you can to avoid that trap.
Yeah, and generally, I think the advice would be that if you are in a situation where you have multiple loans with high interest rates, get rid of the highest interest rates first, because they're the ones that are biting the most in terms of actually being able to repay. And that's not easy for many people, because your point about the distribution is, I think, important. The overall aggregate level of debt may be lower on credit cards, but certainly in my surveys, those with financial pressures and those with negative cash flow are relying on credit cards to get through. But unfortunately, what they're doing is just not reducing the capital balance on their credit card. They're just putting money in and taking money out without really making much progress. And in fact, overall debt rising as a result of that. And the trouble is that when you are starting to get desperate, sometimes the decisions that you then take aren't the most logical or financially beneficial for you as a household. It's just trying to sort of make the problem go away quickly without necessarily thinking more structurally about how do I manage it. And I think in the current environment, having a little bit more of a sense of how can I manage this structurally is quite important. I noted there was a report recently that showed that the number of calls to the debt helpline has risen significantly in recent times, which would mirror what I've been seeing in my surveys, which suggests that there is a lot of pain out there.
Yeah. The other thing that kind of aggravates this is the product design. And I don't know if this would be kind of, I don't know, Machiavellian. I'm not sure the banks are that Machiavellian, but the product design encourages you to repay the low price debt first, because the bank puts a home loan repayment in place that is a repayment that will pay off the loan over 30 years, includes paying interest and principal, and it's a fixed repayment until the interest rate changes. But you've got to pay it every month. With credit cards, your repayment can be as low as 3%, 5%. It's got to cover the interest and pay off the debt over 30 years or something stupid, some ridiculous period of time. But there's no actual necessity to actually reduce the balance. So you can make the repayment and then redraw it next week. So you don't necessarily have to reduce the balance. So the encouragement actually is to make your repayments to the lower cost debt and let the higher cost debt run. Now, that's good for bank profits, but not good for you, and eventually can be bad for bank profits, because if you get into too big a hole, you might end up having to be one of those forced sales you were talking about before, and the bank might not get their money back. But now that property prices have recovered, they've recovered almost everything they lost in most cities. Maybe Melbourne's a bit of an anomaly, but in Sydney, Brisbane, etc., they've recovered what they've lost. The bank's not likely to lose that much money. So it's people that are the ones that are at risk, very much exposed.
Yeah, and that's the point there, that from a financial stability perspective, you might have one view of what's going on in the market, but from an individual household perspective, there's a different story to be told. And in some cases, I think people are actually very much under the gun. And it's pretty tricky to manage all this, and that's why the debt helpline is sometimes a very, really important point to go and check in with. I also note that there are a few quite useful tools there that help people to put together a spreadsheet of what is their income, what is their expenditure, all of those things. But step one is to understand the interest rates that you have on your various financial products, whether it's a mortgage or whether it's a deposit account or a credit card. And then step two is to see whether you can do things to improve the situation simply by going on to Canstar and having a look at some of the alternative products that are out there. Because quite often, in my experience, some people can make significant improvements in their financial position simply by just getting a better product.
Yeah, they will, Martin. It makes a massive, massive, massive long-term difference to people in getting that repayment down, because it's not just that the immediate repayment is lower. It's that it also gives you the opportunity, the lower interest rate, to make a higher repayment. So you sort of pretend that your repayment hasn't gone down. You don't reduce your repayments, you just reduce the interest rate and you're paying off more principal. and it knocks a couple of years, sometimes much more, off the term of your loan. Now, that is a liberating thing for people when there's no longer a mortgage, and they can say, all right, what do we do? Do we live better, or do we start putting some money away to retire better for the future? Now, it makes a big difference, so it's time to do that. And you will never get a bigger opportunity to save than on the interest rate on your big mortgage. I just can't think of any better way to actually get ahead. You can take some risky investments. You can bump money into superannuation, but it's a one-way street. You can't get it back from there until you retire. So you're taking a bit of risk that things might not change. But getting that home loan down faster is a great way to improve your financial future, and you can get it there just by reducing the interest rate, and nothing else changes. So I encourage people to do that. Before I forget, though, when you talk about the debt helpline, people should make sure that they're going to the government one.
Yep.
So it's the credit helpline or whatever it's called. If somebody says to you, we want you to pay $1,500 up front to put together a financial plan and work out how to get you out of this mess, well, you might get further out of the mess, but you'll be finding another $1,500 first before you can get into a better situation. The government helpline doesn't charge you. So make sure you go there, not to some of these other players that sort of are more interested in their bottom line than yours.
Yeah, 1-800-007-007 is the number of the recognised debt helpline there. Don't go and Google it on the website unless you are clear that that's where you're heading up, because you say there are a lot of people out there who are actually willing to make money off those people who are in desperate financial straits. And of course, when you are in desperate financial straits, sometimes you don't necessarily have the right filters up to be able to understand what's going on. So it's really important to get the right help from the right sources. And I always go back to that debt helpline, because it is the government funded and backed source. They are very busy, but nevertheless, if you have a real issue, it's worth going there, isn't it?
Absolutely, yeah.
So, Steve, I want to say thank you very much. Really interesting conversation. I think the message is rates are high for longer. We can't expect them to be back down to where they were 2 or 3, 4 years ago. And that means that people have to grasp their own finances, get to understand things a little bit better, and make good decisions on your own behalf to improve your financial state. But of course, also then reach for help, be it talking to the banks about the debt if you're in hardship, or the debt helpline if you need help. There is help, of course, available. And also check the portals, because the information there is really rich in terms of seeing the product alternatives.
Yeah, look, take your future into your own hands, and don't be patient waiting for government to help you, the Reserve Bank to help you, your own bank to help you. Do it for yourself, and do it right now, because it makes a big difference, and no one cares as much about you as you.
Steve, thank you very much. And we'll check in with you down the road as these interesting financial situations develop. Thanks. Take care.
Thanks, Martin. Great to catch up.